Topic introduces the financial economics foundations that support investment valuation, risk analysis, and pricing models within traditional and alternative investments. The program explains how financial markets allocate capital, determine asset prices, and incorporate information into investment decisions. Key topics include informational market efficiency, the time value of money, forward interest rates, arbitrage-free pricing, bond valuation models, equity pricing models, and hypothesis testing. These concepts provide the theoretical framework for understanding how financial assets are priced and how investors evaluate risk and return. Strong knowledge of financial economics is essential for analyzing complex investment strategies and managing portfolios effectively in global markets. A major concept within topic is informational market efficiency, which examines how quickly and accurately financial markets incorporate information into asset prices. The program explains weak form, semi-strong form, and strong form market efficiency models. Weak form efficiency suggests that past price data cannot consistently predict future returns, while semi-strong form efficiency assumes all publicly available information is already reflected in prices. Strong form efficiency proposes that even private information is immediately incorporated into market prices. The topic discusses how inefficiencies may arise because of transaction costs, behavioral biases, or information asymmetry, potentially creating opportunities for active managers to generate excess returns. Understanding market efficiency helps investors evaluate whether active management strategies are likely to outperform passive investment approaches over time. The program also emphasizes the time value of money and interest rate relationships as fundamental principles of financial economics. Money available today has greater value than the same amount received in the future because current funds can be invested to earn returns. This principle underlies discounted cash flow analysis, bond valuation, and capital budgeting decisions. The program explains forward interest rates, yield curves, and the relationship between spot rates and future borrowing costs. These concepts help investors evaluate fixed income securities, estimate expected returns, and understand market expectations regarding inflation and economic conditions. Accurate interpretation of interest rate structures is essential for pricing financial instruments and managing portfolio duration and interest rate risk effectively. Topic further explores arbitrage-free pricing models and derivative valuation techniques. Arbitrage refers to earning risk-free profits by exploiting pricing inconsistencies across markets or securities. The program explains that competitive markets should eliminate arbitrage opportunities through price adjustments, leading to equilibrium pricing relationships. Financial models such as binomial trees and risk-neutral valuation are introduced to estimate the value of derivatives and structured financial instruments. Bond pricing models, reduced-form credit risk models, and equity pricing models are also examined to evaluate default risk, expected returns, and market sensitivities. These valuation techniques provide essential analytical tools for pricing complex securities and managing risk exposures within alternative investment portfolios. The program additionally introduces single-factor equity pricing models and regression analysis for evaluating systematic risk and investment performance. Models such as the Capital Asset Pricing Model, CAPM, explain expected returns based on systematic market risk measured through beta. Regression analysis helps estimate relationships between asset returns and market factors while identifying unexplained residual risk. The program explains that understanding systematic and idiosyncratic risk is critical for portfolio diversification and performance attribution. Investment professionals use these models to assess whether returns adequately compensate for risk exposure and to evaluate manager skill. Financial economics frameworks therefore support more disciplined investment analysis and improve understanding of return generation within diversified portfolios. Finally, topic highlights the importance of hypothesis testing and statistical reasoning in financial decision-making. Hypothesis testing allows investment professionals to evaluate whether observed market relationships or investment results are statistically significant rather than random occurrences. The program discusses sampling methods, test statistics, significance levels, and potential errors in statistical inference. Proper application of hypothesis testing supports more reliable conclusions regarding investment performance, pricing relationships, and market behavior. However, professionals must also recognize the limitations of financial models and statistical assumptions because markets are influenced by changing economic conditions, investor psychology, and structural complexities. Strong financial economics foundations provide investment professionals with essential tools for valuation, risk management, and strategic portfolio analysis within increasingly sophisticated financial environments.